Hello, everyone. Thank you for those who are on time. We're just going to give it another minute or two. We have a lot of people registered for this webinar. So we're just going to give another minute or two before we get started here. But thank you again for those who are on time. Robin, thank you for the shout out in Philadelphia. Glad you're on board here. Good morning or good afternoon, depending on where you are in the country. My name is Rahim. I'll be your co-presenter for today regarding three ways to make executive benefits easier. I also have with me Paul Sargent on the call, who's going to be doing most of the presentation. Just some quick housekeeping for the purpose of the call. Everyone's going to be muted so we can get through smoothly. We will do a full Q&A session at the end, so please hold your questions to the end. You can ask them anytime you want. So when they come up, just ask them. We'll do a full Q&A session at the end. Yes, I hear that echo. We're getting a little feedback here, Paul, just a heads up. A little echo, but I'm going to stop talking in a second and maybe it'll be clear for you.
Great, thank you.
Perfect. So if for some reason you're not used to Quote and Apply, or you don't have our software, you can go into the chat box and you can go ahead and sign up for a complimentary account today if you do not have access to our software. Most people should, but again, there is a link in the chat box to go ahead and get signed up there. Thank you, Michael, for the feedback there. So again, I want to introduce Paul Sargent. Paul's been with Principal for 16 years now. He's been in the advanced markets the entire time. You can see all the those initials behind his name that he knows his stuff. So we greatly appreciate the opportunity, Paul. Our business is really executive employee benefit, property, casualty agents. We have a lot of them on this call here, and I'm sure they're very excited to hear about what Principal has to offer in this space. So again, executive benefits in 3 easy steps. Paul, I'm going to mute myself and take myself off the screen. The microphone is yours. Thank you so much.
Josh, thank you, and thank you everyone for joining us this morning. As Josh mentioned, my name is Paul Sargent. I'm the SVP for Principal's Business Solutions. And what I get to do is I get to work with advisors, producers all across the country on helping their business owner clients do some of the more fundamental planning aspects utilizing life insurance solutions. And what I wanted to talk about with our time today is an area that we have seen significant traction, need, and really, quite frankly, a lot of opportunity in working with business owners around retaining their best people. I feel like, you can't watch the news, read an article, or we're now in the great reset from the great resignation. The war for talent is very real. And a lot of times when we're having conversations with business owners, one of their biggest concerns is really around how do I keep my best people in my organization? And one of the things that they often don't understand and know about is there are alternative solutions, additional solutions above and beyond the qualified plan, above and beyond the group benefits that can really help them enhance the benefits package on an exclusive basis for their key employees. Now, we start talking about executive benefits and non-qualified. a big area of concern with a lot of advisors we work with is, gosh, I'm not an expert in this space. And that's quite all right. What I want to talk about today is how do you engage your business owner clients in a conversation about some of these ideas and solutions? And how do you engage Josh and his team at Back Nine, and of course our team here at Principal as well, to help turn an opportunity into a closed piece of business? So I want to focus really on three core areas of topics today. And really the first part here is identifying the right clients. The biggest question we always get is who's a good fit for some of these solutions? We're going to talk about, based on Principal's data of over 26,000 business insurance clients in our books, what kind of industries, demographics are we actually seeing these solutions make the most sense, and them actually implementing these plans. The second part of it is we're not going to make you an expert today. What we want to do is give you the right questions to ask your business owner clients to open the door to a further discovery conversation. And amongst that, the next part of the conversation turns into, well, we've identified there's a need with a business owner. What do we do as far as determining the right kind of plan design? So step number 3 is really putting all the pieces together and doing so at a very high level today. We're going to get into some of the basic plan designs that we run across on a common basis, but we're not going to spend all day going through all the various concepts and details around that. We're more here to give you an idea of what options are available to maybe guide some of those conversations with your business owner clients. And as Josh mentioned, as you have questions throughout, feel free to throw them in the chat. We'll have plenty of time to address those at the end here. So let's talk about who are the right kind of clients. So as I mentioned, the war for talent is very real right now. I think as we look at where the economy has gone, where the labor market is trending, the need for highly compensated, highly valuable employees, we're seeing that continue to be a key concern for business owners. And it's not just about how they recruit those individuals, but more importantly, how do they retain the ones that they already have? So at Principal, we are known as a small to medium-sized business insurance company. That's where we focus our efforts, whether it's on our qualified plan business, whether it's on our group benefits, or whether it's here talking about our business solutions utilizing life insurance. We survey over about 1,000 business owners every single year on a wide range of topics. In every year since 2015, the number one concern we have heard from business owners is protecting my business, and primarily around protecting my business from losing the key people in my organization. Those that drive revenue through sales, those that manage customer relationships, those who are the linchpins in their companies. They are the ones they're concerned about losing, whether to a competitor, to a different industry, and being competitive in the benefits that they offer. And so what we're going to talk about today is how do we approach these kind of organizations with that end goal in mind? So if we think about the industries right now that this is most relevant, where we're getting the most doors open and where we're seeing the most of these plans actually implemented, it goes into a handful of organizations. So as I go through this, what I would ask of everyone on the call today is think about your own existing client base. Think about who might match up with some of these industries, some of these business types. And then we can have a follow-up conversation with Josh and his team about approaching some of them with these ideas. So the number one organization where we've typically seen great success in this kind of space is in the construction business. While we're starting to see a little bit of a slowdown where, interest rates have risen a little bit, building, whether it's commercial or residential, construction has continually been a growth engine over the past 5 to 7 years. Whether it's actual contractors, whether it's, plumbers, electricians, depending on where you are, maybe it's a pool company in your local area. Anything construction related right now is a very good fit to have these conversations. A lot of times the issue that they're facing is those project managers that are great at managing subcontractors, they're worth their weight in gold. The concern is, are we going to lose that individual to somebody else by them offering a higher salary? How do we can kind of sink our teeth into those individuals? So think about your contractors, your engineers, your plumbers, your roofers. Those organizations right now are certainly one that are ripe for these kind of conversations because they are seeing their people leave in droves. The second group is more around our professional service, your white collar organizations. And think about your law firms, your CPA firms, again, going back to engineering and architecture firms, and the medical and dental practices. The reason why we see a high turnover is that these markets are very competitive. They're very specialized. Other firms are willing to pay top dollar to recruit individuals away that have a special skill set, whether it's a specialized law practice, an architecture background, and then certainly in medical and dental practices as well. There's a lot of consolidation going on there, and a lot of these organizations are looking for ways to retain those key people within their organization without just throwing compensation, salary, or in some circumstances, actually giving away stock or equity positions in these firms. They're going to be really open to conversations about alternative ways to keep those key people in their organization. Another group to think about is manufacturing. If you think about the makeup of a manufacturing organization, you typically have the laborers working the production line on an hourly basis. A lot of times aren't concerned about the 401k because they're, a lot of times living paycheck to paycheck, or, aren't the highly compensated individuals. But on the flip side, you've got the C-suite, the management, the executive team, where a lot of times because of the nature of that disparity of compensation, they're limited in the 401k. They may be failing some testing on the 401k, not able to contribute the entire amount in a given year. They're great fits to go in and talk about supplemental executive benefit planning for retirement benefits, just by nature of how their compensation structures are built in there as well. And then the last one is more broad-based, but one that we see quite often. And many of you, and I'm guessing all of you, probably have family-owned business clients. And one of the things that we typically find with family-owned business clients is a lot of times they're going to have someone in there who's maybe a non-family member key employee. Maybe it's a longtime friend. Maybe it's someone who's simply come up in the business and grown to be a valuable asset. A lot of times what we will see is that family businesses are really good about giving away equity positions in their closely held family business to retain someone who's a non-family member key employee. A good example is this. We had a construction company in Southern California. It was a husband and wife who ran the business. They recruited over an outside project manager and gave him a 25% stake in the company to join their firm. Keep in mind, he is a non-family member. All of a sudden, a few years later, they wanted to transition the business to their son. Well, with a 25% minority shareholder being a non-family member, there was already going to be issues as far as continuity planning with the new ownership. So the challenge can be with those non-family member key employees is how do you create incentives for them to stick around long term, but not necessarily give away equity in the business. And we'll talk about different ways to achieve that with some of these plan design options. So again, think about the clients inside of your book of business that fit any of these demographics and write those down so we can have a follow-up conversation at a later date. So we think about the overall labor market. We think about those industries that we just talked about. Every month, the Department of Labor comes out with what's called the Job Openings and Labor Turnover Survey. You'll also hear it called the quits rate of time. This is the number of people who voluntarily left their job in a given month to go somewhere else. Not because they retired, not because they died, not because they went on Social Security. They simply went somewhere else. They quit and went to another organization. July was actually one of the lower months this year. It's been hovering between 2.1 and 1.4. But 1.3 million people in July alone left their jobs in those organizations to go somewhere else. When we talk about the need to put these kind of retention plans in place for business owners, they're very much feeling the consequences of people jumping ship to go somewhere else. So let's talk about step number 2. We've identified the right kind of clients to talk to, but let's talk about what are some of the ways you can open up a conversation with your business owner clients to have a further discussion around putting one of these plans in place. And again, I get the benefit of working with advisors all across the country, so nothing here is original content for me. These are things that we hear consistently used from advisors with their business owner clients. So one of my favorite things to ask a business owner when you're having that annual review conversation with them, when you're doing re-enrollments, when you're doing plan reviews, is talking about, we think about life insurance and key person as what happens if one of your key employees dies and the revenue. Let's put something in more realistic terms for them. What happens what happens tomorrow if one of your top employees walks in and hands you a resignation letter? Ask them, who is the last person you want to have walk in tomorrow and hand you a resignation letter? And once they start thinking about, gosh, it's this person or this person, if they walked in tomorrow and resigned, they manage my customer relationships. They're my number one salesperson. They know where all the devils are in the details of our accounting. I don't know what I do without them. You can have a further discussion on what are you doing to make sure that doesn't happen. and helping them understand there are additional plans that are available. Make things relatable to them as well. The number one concern we hear from business owners is protecting against the loss of key talent. I'm sure you, Mr. and Mrs. Business Owner, have seen all the newspaper articles and segments on TV about the Great Resignation, the Great Reset, the turnover of labor market. What are you doing to make sure that you're addressing those concerns with your key employees? And then maybe have a different conversation than a lot of other advisors in this space are doing, and talk about, we provide solutions that help key employees think like an owner, act like an owner, but let you maintain control of your business. So think about those family-owned business organizations where, a lot of times they're going to give away that stock to incentivize that key employee to stick around. Another example of this, we had an engineering company in Colorado where we reviewed their buy-sell agreement, and there were 15 owners in the company. 2 owners owned about 70% combined of the company, and the other 13 owned the balance of that. The smallest shareholder was about 75 basis points. Their retention mechanism was to give away equity in the company to retain these engineers long term. The issue now is the majority shareholders were diluting further and further of their equity positions, which means when there eventually becomes a transition, there's less equity, there's less cash, there's less money, there's less retirement benefits. They were looking for alternative ways to do that, and that's where a non-qualified plan can really come in. And the last one, we've seen this used for this actually came from a CFO of a large construction company in Iowa that we work with. He talks about they provide asymmetrical benefits to their asymmetrical contributors. A lot of business owners know that qualified plans, group benefit plans, that those are non-discriminatory plans. Everybody has to get the same benefit. What we're talking about here is creating exclusive benefits for key people using non-qualified. So it's the opposite of what we typically would do in a qualified plan, where we can actually pick and choose who participates in these plans. And a lot of business owners don't know that that is an option available to them. They know they've got the non-discriminatory plans in place. What can we do in order to solidify those executive benefits for those key people? So educating them on what's actually available as well. So to kind of illustrate what this really means and why this is relevant for key employees, this is a great chart that shows basically the impact of high income earners and the retirement gap they're likely going to face. When we think about higher income earners, the more money you make, the less of a percentage of your overall retirement income replacement need is met through qualified plans and Social Security. There are limits to Social Security. There are limits to how much you can put in a qualified plan. And the more money you make, the less percentage of your overall income replacement goal in retirement is met through those plans. The issue that a lot of highly compensated individuals make is, how can they bridge that gap? So we started thinking about those executives, those key employees, those higher income earners. We've got to find a way to maybe fill the void. And it's a great way for an employer to step in and solidify their value to those key employees by providing a supplemental retirement plan utilizing one of these solutions we'll talk about here in a moment. So again, I like this slide because it does show the fact that the more money you make, the actually harder it is to save for retirement, given the limitations that are put in place with traditional retirement plan benefits. So now we're into step number 3. We've identified who are the right clients. We've opened the doors to the opportunities. Now it's a question of, how do we determine the right kind of plan design? Now, we could talk about all the various types of non-qualified plan designs that are out there and spend a good 6-7 hours doing that. Don't have the time to do it on this call today, so I want to get you comfortable with asking the right questions. And again, it's more about finding what's the biggest priority for the client, and then utilizing a couple of our common plan designs, and certainly utilizing our team to help determine what's the right solution for that particular client. So the key question is, once we've identified there's a good fit to have a plan design conversation, we want to get comfortable with these 3 questions. The first question, we always want to know what the corporate tax structure is. Are they a C Corp, S Corp, LLC? How is that business taxed? That will determine, in a lot of circumstances, from a tax planning perspective, what makes the most sense from an overall plan design. Once we determine that, we want to know, who's the plan really for? A lot of times it's strictly for the employees, but when you can explain some of these plan design concepts to the owners, you oftentimes will get the, gosh, that sounds pretty good. Is there a way that I can be a participant in that plan as well? And the answer is sometimes yes and sometimes no. It's very common for us to have a plan that's built solely for employees, and there's a separate plan built solely for the ownership group. And that will likely depend on their overall goals and objectives and their corporate tax structure. So who is the plan really for? And the last question, when we think about those employee plans, we're thinking about their key employees. When you're talking to that business owner, what is more important to that business owner when we put this plan in place? Is it having control of the plan assets, or is it getting our tax deduction today down the road versus down the road? Now, every one of the plan designs that we're going to talk about very briefly is going to have some sort of tax deductibility to the business. The question will be, is that tax deduction come today, or does it come down the road? So the most common plan designs over here on the right, we're going to talk about executive bonus. We'll talk very briefly on split dollar, and then we'll talk also very briefly on traditional non-qualified deferred compensation. These are by far and away the three most common plan designs we see in the industry. There are several others that are a little bit more niche, but certainly these ones will give you a high-level overview. So by far and away, the most simplistic form of a non-qualified plan is an executive bonus plan. And the good way to think of this is we're simply providing a current bonus to the employee, but rather than depositing it into their checking account, we put it inside some other financial instrument inside the plan. A lot of times we're going to use a cash value life insurance policy, and the employee is going to own that asset, name their own beneficiary. If it's an investment related product, they can make their own investment allocations, but ultimately the employee truly sees it as a personal additional benefit to themselves. Now, why this plan makes a lot of sense for a business owner is it does give them current tax deductibility. That bonus they pay out is W-2 compensation, so it's immediately deductible to the business, but it's also a great way to reward that key employee. Now, the downside here is we think about the trade-off of current tax deduction versus control. The employee owns this asset. So if the employee gets that job offer somewhere else, they own this policy. They can take it with them as they leave the company. So the risk is more about you're getting the current deduction, but giving up control. Now, some of the things that we can do to maybe soften that exposure of risk, we can put vesting schedules on employer contributions, or if the employee leaves, they're leaving money on the table. We can also put what we call a restrictive agreement, which essentially limits the employee's access to the money inside the plan while they're employed in your organization. But it's a way ultimately where the employer can get a current deduction, but they are going to give up some control. Now, if control is more important to that employer, we're really trying to create a long-term retention tool, dangle a carrot out. We don't want to give away stock. We'll do what we call a deferred comp select reward plan. And all this is, it is a promise to pay benefit at a future date. So if Josh is my key employee, I say, Josh, hey, if you stick around in my organization for the next 7, 10, whatever number of years we decide on, every year I'm going to set money aside in this plan. If at any point in time you leave, your plan is unvested, you walk away from that benefit. But if you stick around for that 10-year time horizon, I'm going to bonus you out that plan asset. Now, for me as the business owner, I don't get my deduction today because we're promising a future benefit down the road, but I'm creating a control where if Josh does leave, I retain 100% control of the asset. If he stays, fulfills his obligation, I bonus him out the value, I get a tax deduction because he's receiving that bonus at a later date. So we look at this as a great way to incentivize long-term retention planning, and can even be a way to help a key employee transition that business to that key employee utilizing one of these plans to help create a down payment strategy long-term. So if control is more of a concern, then we start talking about this select reward. And the last option is more of a hybrid of the two. We think about defined contribution plans. These are your full service traditional deferred compensation plans, where this allows to look and feel a lot like the 401k, where an employee can essentially defer up to 100% of their own salary into this plan on a pre-tax basis. So again, a lot like the 401k, but does require that they meet the IRS's definition of a top hat executive. And the employer can set up a match. They can set this up where it's all employer contributions. But this does give a lot of flexibility where we have employees who are maybe high income earners who are paying a high income tax rate now, and they do feel like they'll be at a lower tax rate in retirement. This additional plan design can really make a lot of sense for those organizations that have people really maxing out the 401k, have a lot of folks maxing out the 401k, and are looking for additional ways to save money on a pre-tax basis. What I will tell you, if I look at every 100 executive benefit opportunities, maybe 3 to 4 out of that 100 really fit in this space, because this is really geared more towards C corporations, where it's less about the owner than it is the employees as well. So this plan design, again, makes a lot of sense when you got larger organizations where you're typically going to do over $250,000 of annual flow into the plan, but it's something that we do a significant amount of as well. So again, it really comes down to what's most important to that employer. Is it control, or is that current tax deductibility? From a product standpoint, again, not to plug Principal too much here, but obviously this is what we do on a day-to-day basis. So our products are really built with the business owner marketplace in mind. Whether you're variable licensed or not, we have fixed products, variable products that are really built for these executive benefit kind of plans, as well as our underwriting platforms as well. And that's why we rely heavily on Josh and his team to make sure that when you do have the opportunity, that we're here every step of the way. Whether it's the pre-sale consultation, our team is available to do all that work as well. Access to our CPAs and attorneys within our advanced markets team. And then once we actually have one of these plans, a key aspect of this is we want to make sure these plans do exactly what it's supposed to do. As I mentioned, we record keep over 26,000 business insurance plans. We do that in-house, and we do that at no cost. We're not using an outside TPA. We're not charging a fee. All the record keeping and administration is done in-house here at Principal. And we've been doing this for decades now. So when it comes to knowing what we're doing in the space and wanting to make sure that these plans, do what they're supposed to do, our team is here for you every step of the way. So I know I covered a lot of content here in a very short amount of time. Josh, I want to see what questions are out there that I can answer with our time left here today.
Thank you so much. Great job there, Paul. So let's go ahead and get some of the questions going. They're already coming in here, but go ahead and put your questions in. I know that one thing that's going to come up is how many people do we need to get this? What's the minimum? And then I'm sure there's no maximum, but go ahead and talk about how many lives do we need potentially for guaranteed issue.
Yeah, so we do offer guaranteed issue down to 10 lives, and it will depend on our guarantee issue underwriting, the amount of life insurance we get there. It's a multiplier based on the size of the group. So it's a minimum of 10 lives, where we get creative is really around the plan design here of figuring out what's the right amount of insurance based on the contributions to maximize efficiency. Our team helps spearhead all that to make sure that, if you're working through one of those opportunities, that we're putting the right kind of solution for your client. But 10 lives, and we have no limit as to what we can do on GI as far as number of lives.
Perfect. And then someone said, again, keep those questions coming, everybody. Pour those questions in now. Go ahead, and we're going to we're really done with the basics. We're going to go to question now, Q&A. So what size do you recommend targeting? And then how many executives do you typically design these plans for?
Great question. I would say really the sweet spot of revenue is 5 million of gross revenue plus. We do work with revenues that are smaller than that, but what I would tell you is a lot of times their appetite and budget to implement some of these plans can be a little bit smaller. But as far as the size of the executive group, we do plenty of plans where it's on a single individual. And we do plans where, on the larger scale, we have hundreds of participants. So I would say kind of our sweet spot is in that under 25 range for executives. Some of these plan designs are really built for less than 5. And again, we start thinking about the small to medium-sized business. They may not have 100 key employees, but I bet you they have 2 or 3 that are absolutely vital to their organization. And so we do a lot of plan implementations with 2 or 3 individuals as well.
Perfect. So just to kind of recap what Paul said, I know a lot of you on the call, if you're in the employee benefit space or property casualty space, you're used to maybe doing guaranteed issue. Well, here we can do one life. It's just one life's going to be fully underwritten. Is really what Paul's mentioning here. But again, a lot of those plans, there's only 1 owner, 2 owners, 3 owners. So those are great cases as well to be able to, if we have 10 lives or more, we can get into the guaranteed issue space. And that's a fun space to be in as well. So perfect. The questions are pouring in here, Paul. We're gonna get to a lot of them here. So perfect. So someone said, how much role does term play in the executive benefits like that you quote?
Yeah, that's a great question. So I think we've seen more of it in a specific spot. So one of the things that's unique with Principal is we do offer on a guaranteed issue basis our retail term product. So where I think it might be beneficial for this group on this call is where we're seeing an opportunity there is a lot of times when you have maybe a group term benefit in place with an employer, a lot of times your executive groups, their percentage of salary being replaced inside the group term plan is pretty small. So what we've seen is an equalization strategy where essentially the owner can implement our guaranteed issue term product as a way to enhance that employer paid term benefit to the employee and basically get them on par with the rank and file employees as far as a percentage of salary replacement. So as an example, if you got a $50,000 base group term benefit and an executive making $300,000, we can essentially do a guaranteed issue term product for that collective group to give them additional benefits to restore that percentage to those key employees. From an outside of that, from a basic key person term insurance revenue replacement, essentially, one of our biggest selling concepts. You got a key employee that drives revenue in your organization. You're worried about them getting hit by a bus tomorrow and losing all that revenue. Having basic term insurance owned by the business on a key employee is a way to protect them from that happening. It's a very common strategy that we see as well.
Thank you very much. I appreciate that, Paul. So someone said if we have businesses that are in multiple states, I kind of know the answer to this question, but how does it work with like licensing and what state do we use as the main? So just with where the company is.
Yeah, and so my understanding, it will depend on the plan design and implementation, because if it's all corporate owned, you only need to be licensed in the state where the corporation is domiciled, because that's the owner of the plan. If you have a more of a bonus structure where you have employees that are going to own these policies in respective states, my understanding is we do require, or states do require, to be licensed in those respective states where an executive bonus plan will be implemented. But we can, Josh, I don't know if you know that off the top of your head, but that's my understanding. I would believe how that has to happen.
Yeah, correct. So it's going to be where the main company is. But again, if it's individually owned or if it's business owned, we'll definitely determine what states you'll have to be licensed in. But I'm assuming that most people on this call are going to be licensed in multiple states. But that's a really simple fix if you're not for some reason. That's a good question there. Perfect. So someone said, if we want to get, what do we need to get to look at one of these cases? I know the answer to this too, but I want to hear it from you. So I want to move forward, or I want to talk about some cases. What's needed to get rolling here?
Yeah, so I think the first thing that I like to do is set up a quick call just to do a little bit of discovery. Because again, if we've got an opportunity, one of the things we want to vet out is, really what their overall goals and objectives are. Once you've figured that out, we have a very simple process as far as getting financial models, RFPs, all that fun stuff, actually get proposals put together. Really what we need is very basic information about the employees, executives that we're going to put in the plan. So, names, dates of birth, gender, any known medical issues, anything that we would traditionally think about for life insurance underwriting. But then what we're looking at is, what kind of plan duration, like how long before the employees are going to receive the benefits, what kind of contributions does the employer want to make inside the plan, what kind of vesting do they want to see? And again, that will all come from the discovery. I think one of the questions that I typically would anticipate getting from a business owner is, well, what's the norm? What kind of dollar amount? What's the going rate essentially that you see other business owners put in place for their key employees? And I would tell you, our experience has been somewhere in the 10 to 20% of their compensation into one of these plans. And the 10% is the baseline. That's someone who maybe they're replaceable, maybe that they're not as highly specialized, but you still want to create an incentive. And then the higher spectrum, that 20%, is more of this person's really difficult to replace. They're very specialized. We want to have a higher percentage of their salary. So you can go in saying, here's kind of the range of what we commonly see as far as plan implementation and the amount of money that employers are allocating towards these kind of plans for their employees.
Perfect. So it does sound like this is not really a cookie cutter type setup, because obviously every business is different. Every business can be unique, right? So it's just going to be a matter of, we want to make sure that you reach out to your marketing manager for those who are on the call, and then they're going to go ahead and get in touch with Paul, and we can set up a one-on-one. and we can go ahead and kind of just do some fact finding here. And I know that census at some point will be needed, right, Paul? So really, first, last name, income, job title, things of that nature, real basic stuff that's needed here. And I think if you're in the employee benefit property casualty space, a census should be your middle name, right? It shouldn't be too hard to come up with. So that was a great question. Someone did ask, I know you showed some cool slides here about like the process. I don't know if you have a PDFs that you can share with us, Paul, that we can get to all the agents that might be able to just show them this 1, 2, 3-step process. Is that something that we can do?
Yeah, I'll certainly send the slide deck here out today as a follow-up, and I've also got just some very basic collateral. And one of the things I've also got is a more detailed client profile sheet. So I keep referencing our 26,000 plus business clients. We've got a more detailed grid-based marketing piece that talks about the industries and overall business planning, and then it breaks it down into concepts: key person, buy-sell agreements, what industries are most common, revenues that we have on our books. And what's nice about that piece as a follow-up is it allows you to dig a little bit deeper into your book of business and say, gosh, I've got a bunch of construction clients that we do the bonding for, that we should probably have a conversation about their buy-sell and business continuation plan, and bring us in for that as well. So I'll send that out as a follow-up to our conversation today as well.
Perfect, Paul. And again, we know this is a lot of information for all of you. So it's really important to understand you're not here alone. This is not something you're going to have to go present to your client by yourself. We are here every step of the way. Again, there's a lot of experience from Paul to myself to all the marketing managers here at Back Nine Insurance. So we're here, but I like principle that they can handle really every single aspect of this. And correct me if I'm wrong, but you've been doing this in this business space for an extremely long time. So I'm very comfortable recommending you to all the agents on this call here. But it really just starts with I got a guy or a gal, right? Or I got a business. That's really where it starts at. And then we can kind of go from there. We can get you the tools you need. We can help with the sale of getting the case closed. So yes, this will be recorded, and you'll all get a copy of the recording that will go out there soon. A few more questions here. This is great, Paul. Are you okay over there?
I'm doing great, yeah.
Perfect. So someone asked if you can maybe just give us like a high-level version of split dollar designs, if you don't mind.
Yeah, so I mean, there's really two core split dollar designs that we see used right now. When we think about split dollar, I mean, split dollar is not as complicated as the marketing content out there will tell you it is. That select reward plan is essentially a very basic endorsement split dollar. And the reason why we refer to it as endorsement split dollar is that in that plan where, hey, we're promising Josh that future benefit. If Josh dies at any point in time before that benefit vests, we want to split the death benefit, some going back to the corporations, some going back to Josh's beneficiaries. And in order for that to be a tax-free benefit to his beneficiaries, because it's all employer paid, he has to recognize that economic benefit of the insurance that's being allocated to him. So he's got to pay tax on that every single year. Now, the good news is with principal, we do all the record keeping, but the idea behind endorsements for dollar is all we're doing is splitting the actual death benefit for the employer and the employee. The other one that we have seen quite a bit of as well, that has a little bit more layers of complication and moving parts to it, is you'll hear called loan split dollar or maybe loan regime split dollar. And this one works really well in the nonprofit space and credit unions, where Josh is my key employee. And what I'm going to do is I'm going to loan him premiums to fund a heavily funded cash value life insurance policy that he owns. And what he has to do is he has to pay tax on the interest of that loan every single year. And then what I do as the owner is once he completes his obligation, I can either make him repay the loan via cash from the policy or somewhere else, or I can forgive the loan and he's got to pay tax on the entire value. The idea behind this is that you're giving the employees some control of the plan because they own the asset, but you've got a built-in cost recovery mechanism for the owners who are loaning out those dollars. And what's nice about that is the out-of-pocket expense for the employee is just the tax on the loan interest. So you can get a lot of money into a plan with not a lot of outflow and taxation up front from the key employee. So we have seen those plans utilized quite a bit. If you're a college football plan, I feel like every Power 5 coach has a loan split dollar plan in place as a part of their contract. But we are seeing more and more of that business continue to come in as well.
Beautiful. again, we don't want you to feel overwhelmed here. I know this is a good amount of information, but the goal is to keep it very simple. So the hardest part about doing any of these cases is having the clients. And there's a reason why you're all on this call here, because I'm assuming you're in the space of working with business owners. So you have the clients for this. We don't need 100 businesses to make something work here. Start with one. Just think about who is my best potential opportunity with what Paul had mentioned in this space, whether it's construction or white collar, who would be the best client to talk about this with? And then we're here every step of the way. So you just reach out to your marketing manager, get them involved, and we can get Paul on the call here. He does a phenomenal job talking to the clients. We can be a resource, and we can really just dig and figure out what the best option is for your client, whether it's term, whether it's IUL, whether it's current assumption, or whether it's VUL. What's the best fit? That's what our job is here. Perfect. Any last minute questions? There's a lot of any other questions that you might have? I want to bring up something, but I want to see if there's any other questions here. What are we talking about money here? No one's mentioning money. I love it. It usually comes up at least one time, Paul. What type of commissions are we potentially looking at? Do you maybe have a case you can brag about or talk about, or how are we looking at here for show me the money, Jerry Maguire style?
Yeah, I mean, it's a wide range because again, the plan designs, are built with customization around, the size of the organization. So we work on plans that can be as small as, 10, 15,000 of annual flow into the plan. And then we have plans, that we have in the works that are, 7-figure premiums. I would say our average plan design typically generates on the bonus or the select reward plan, typically generates somewhere between 20 and 50,000 of first year compensation on these plans. And then obviously the more flow that goes in those plans, the bigger those numbers get. I mean, I'll give you an example of a loan split dollar case where it was an executive hospital group that generated $500,000 of revenue for the advisor. And it was all based off of, trying to incentivize some of their top executives to stick around for a few more years. So those kind of plans are a lot of fun to work with. The revenue stream is not like selling key person term insurance. They're higher dollar cases, and doesn't mean that they're more complex. That's why our team is here every step of the way, to Josh's point.
Perfect. And just to point out a few things there, if you are an employee benefit or property casualty agent, we know most of you are getting paid that 10% commission, right? When you come into a case like this, you're talking about upfront commissions. So that's truly a beautiful thing that can help out. Also, we call these plans the gift that keeps on giving. And what I mean by that is every single time a new employee comes in, and if you go on the guaranteed issue route, all you do is you fill out your one pager for your underwriting, and then you submit your income. And this is a brand new life insurance plan. So what that means is also a brand new commission. Does that make sense, everybody? That's why I call it the gift that keeps on giving, is because you keep on getting paid on every single time a new employee comes into the company. So these are truly beautiful plans. They're years and years. It's not just a one-time thing, because we know that new employees come in and we know new employees leave as well. But every time they come in, there's a new life insurance sale, a new commission. So it's truly an amazing thing. Paul, I want to thank you so much. You did a phenomenal job here. And I thank you all for everyone who's on the call. There will be a recording copied, sent out to every single person who was not able to make it. If you were, you can go back. I know it was a lot of information, so you can go back and see everything there. I really appreciate you, Paul, and I really appreciate everyone on this call. Please reach out to your marketing manager. If it's me, call me. I'm here to help. If not, call your marketing manager, and let's see if we can get some cases going here and help to start doing some more principal business. Again, Paul, thank you again. I really appreciate it, and thank you, everyone, to call. Everyone have a blessed day, okay?
All right, thank you, everyone.
All right, bye-bye.